Welcome back to John Orfer's Note. It wasn't so long ago that the US Treasury market, UK gilts, German bunds were the safe havens in an uncertain financial world, the paradises, if you like. But the world's been changing a lot recently. We have signs of global economic recovery, yet central banks are still out in force. With me to discuss what this means for investors is John Beck, who's the co-director of international bonds at Franklin Templeton. Thank you, John. What we've seen, of course, over the last few years is a very dramatic fall in yields for UK gilts, US Treasuries and for German bonds. If you look at the chart there, the question is, of course, have they gone too low?
Well, I think, first of all, one has to acknowledge that the decline in bond yields that we've seen has been a deliberate act of policy from many of the central banks involved. So I think for those that are perhaps fearful that we'll see a repeat, which all bond managers remember, of 1994 and a sharp increase in bond yields if short-term interest rates were to change, I think probably there are a number of reasons not to expect that. But I think nevertheless there are still lots of reasons for investors.
We have seen a pickup.
Yes, I think very modest, but really I don't think anything terribly material. Short-term interest rates, I think, are going to remain anchored for some time, but it still doesn't avoid the point that for many investors outside of the domiciles of many of these countries, there are investment alternatives.
Yeah, the question is, why would you buy UK gilts when they're yielding such low interest rates at the moment?
And I think that we're seeing part of that answer in both the success in development in the retail market, in the corporate bond sector that are very popular, and also obviously partly in the weakness of sterling. And the
weakness of the Eurozone, maybe worries about Italy driving people back into gilts though?
I think as a knee-jerk reaction there are still groups of investors that will make that type of judgment, but I think the broader term outlook for many of those groups is that we're increasingly finding discrete groups of investors. So there are traditional buyers of gilts, the UK banks. There are traditional buyers of Italian bonds, the Italian banks.
So you'd expect to see that perhaps widening out the divergence between German bunds, for example. I mean, different set of dynamics.
Yes, I mean, I think that if you look at the yield that you get on the German government bond and you compare that to the stated ECB inflation target, to buy something at a negative 0.5% real yield is going to be a challenge to sustain.
What we haven't mentioned so far, of course, is Japan. We have a new government and a central bank poised to take more aggressive action. That's obviously going to have a big impact on the Japanese bond market. Does that mean there's another twist, if you like, to the cycle?
Well, of course, here we're showing the yen more than we're showing bond yields.
This is the yen against the dollar and the euro, falling quite sharply, very sharply.
Yes, and I think that is the natural reaction of a policy of a government and of arguably perhaps now equally of the central bank to wish to see a weaker currency. The markets move, but as Mervyn King said at the last inflation report, we have open exchange rate policy. We don't have a fixed exchange rate policy, but exchange rates react to changes in domestic monetary policy.
But those sorts of currency movement must have big impact in neighbouring countries, but globally as well.
Well, they do, but I think that what the chart perhaps doesn't show sufficiently is the direction from which we have come. So if we turn back to 2008, the yen was trading at levels that are still above where we are now.
Okay.
And the movement that we have seen, albeit a relatively sharp movement as the chart will show, really is only returning partly to status quo ante.
So, John, final question, where are the safe havens these days for bond investors?
Well, we find more and more that the argument that this is found in the AAA sector is really something of a red herring, and that there is such a migration of assets, the AAAs weakening and the single A's and the triple B's strengthening, that somewhere around the middle really is where you should look.
John, thank you very much. So we can still see the impact of central bank action on government bond yields globally, but some subtle shifts going on there away from the safe havens into newer markets, newer investment opportunities.